Whether you're a trader or an investor, it's clear to see that sentiment is starting to shift. So what are the lead indicators that we need to be looking at right now? And more importantly, where are the opportunities in this market? Whether you're a stock, commodity, or crypto investor, today we're going through everything together in our special weekend video. But there's also two particular stats we need to talk about. And one of them has to do with this chart and the secrets that it holds. Let's get into some very interesting stuff. It's going to be a good one. Join us. Well, welcome back everyone to the special weekend edition of the show. My name's Tom and I hope you're having a great weekend so far. As always, we're covering the macro, the data, the lead indicators, and everything else to help demystify the markets and why they're all connected together and where the flows are moving. Remember to subscribe and smash that bell icon, and we'd love to have you on board. Looking forward to seeing you in the comments below. So what's going on with unemployment? Because of course, Jerome Powell is playing a bit of a game with us that we'll talk about in today's video. Are we entering into stagflation? Well, some things say that we may be, but this is a very important one. Unemployment rate, because of course we saw a softening of the market through the jobs numbers that came out last week with them under what Wall Street's expectations were. So whenever we cross above the 24-month moving average, as Octavio says on X, that tends to lead into a fairly steep increase in unemployment. Now, that could mean that rates are about to come down, but actually a lot of the time it leads into a recession, a very bad time for, of course, markets. Now, there is one period where we seem to get through that, and that was the dreaded stagflation of course, the 70s. Now, if this is true, what could happen is we see an up, down, and all-around market as the Fed tries to navigate a soft landing or whatever is going on. And you'll notice that most people have stopped discussing the idea of any type of recession or hard landing, especially over the last 6 months. So is it time to panic right now in markets? Well, here are some other reads that show you when we go above the 0.3 ratio, again, things start to get a little bit weird. And you'll notice that in the 70s, this is something that happened a couple of times, with it leading into, unfortunately, a couple of recessions in markets. But I think that we need to come back a step here because, of course, people will freak out whenever they talk about these things. And you need to be a bit more balanced in terms of whether you're going to be a bull or a bear in markets. So we saw some bad reads last week, particularly America's consumer sentiment stocks. Things like Starbucks, things like McDonald's report pretty poorly. And I saw a lot of people discussing this comment. And of course, they were saying, well, the economy is very weak, therefore. Well, there's a couple of things that I think some people in the comments down below in this particular post figured out. Number one, we've got wages up. Number two, that means that prices are up. And of course, yes, people will be spending less due to that. And also, it may be just consumers moving away from McDonald's and Starbucks and moving into some other options as well. The key here is, though, is where are we right now in terms of the psychology of the market? Are we in a period of euphoria or are we in the period of belief? Now, in both cases, you really want to know where you are because, of course, in general, if we're in a belief period, then we should be seeing a higher market over the next maybe 12 to 18 months. But at the same time, whenever we enter into a belief period, we should also see certain shows of flow, that is money moving around in Wall Street, that starts to turn a little bit defensive. And I think you'll be surprised where some of the flows are starting to turn. So let's look at one of the big bull indicators right now. And of course, this has got to do with the volatility index. We talked about when the vol goes up and it hits something around that 20 level and then it starts to crash back down. If it gets below the 15 zone, that tends to be a little bit more bullish than you would expect from markets. Well, that happened as of Friday with rates coming down across the board. And there are some opportunities that might be starting to arise from this. But on top of this, we also saw the rate of change crash from from 40 all the way down to negative 20. Now, in the recent times we've seen this, it's marked the bottom or a turning point for markets. And you can see here that when we saw similar occurrences on the charts here, it actually meant that there was a bit of a bull coming back in. On top of this, we've got advanced decline increasing, which means that actually a lot of stocks are starting to improve. And this has an underlying kind of bullish tinge to it. Even when we overlay it with some of our favorite correlations right now to do with election years, we'll notice that 2012, which we've been talking about for months now, is our most correlated market. Now, does that mean that we're going to go a little bit further down? Could we hit a 50-week moving average? Well, we could, but things are starting to look a little bit less for that, which is, of course, one of our worst case scenarios this year, which was that negative 10%. We end up getting negative 5 and a bit to 6. So still got around what you would expect in a lot of these years. Now, why is this important? Well, because, of course, we usually get a nice uptick followed by some concerns about the election itself, because it's probably going to be hotly contested. And at the same time, this is a pretty good track record of what's happened so far. Do we have some more records to go with that? Yes, here are all of the election years. And as we've talked about several times, 2012 and 1976. And I think it's very important to factor in here 1976, because of course that was around that stagflation time that we're starting to follow. Now, in that one, in the 1976, we didn't actually really start to move up until around June. In the 2012 situation, we didn't start to move up until June. But May, historically, a lot of people say sell in May and run away or go away or whatever. Yeah, the stats aren't really that good for that particular type of strategy. They were in the past, but they're not as anymore. So why I want to bring this all in is because flows are starting to turn. This is how the S&P 500 performed by sector in 2023. And you'll notice some factors here. We had communication services, infotech, discretionary, all up the most. Now, what is that telling you? An expanding or recovering environment in the markets. They're all outperforming the S&P 500, tick. Are they looking a bit more bullish? Tick. And most of this really started heavily in, of course, that October rally that we ended up seeing. On top of this, we saw utilities, energy, staples, and healthcare, all the defensives, staying low. Now let's bring it in to 2024, though. What's doing well? What's starting to do poorly? Communication services, still doing well. So again, growth there a little bit. Energy sector, financials, utilities, industrials, with a lot of the infotech sector actually low. So what have we got here? We've got some defensives starting to play through. And we've been talking a lot about the energy sector, the financial sector, and the utility sector in recent times. And in particular, I think everyone should be specifically looking at utilities and financials moving forward. Financials for health of the market in terms of showing that debt creation is going on right now, which in essence is a lot of how these Western societies like ours grow nowadays, and utilities by the defensive nature of flow. Now, you might say, yeah, but it's going up because, of course, of inflation and all these other things. But I have a guess that utilities is starting to become a Wall Street staple over the next couple of years. And I wouldn't be surprised if it starts to perform very much in line, if not a little bit better than the S&P 500, as we enter into a very questionable period for the next couple of years for all markets around the world. You're going to have to start being careful. Now, another one of the concepts that we've been discussing is the idea of improvement in the emerging markets. So, of course, we've seen US do very, very well, but what happens next? Well, we have kind of two pillars at the moment. One of our pillars is, of course, data and investing in the concepts of data. Also, geopolitical concerns are becoming bigger around the world. And, of course, that means that we're looking at metals, miners, inflation-based trades, and all of these other things. It's very unlikely that the Federal Reserve will be able to cut too much into a fairly strong economy, but at the same time also an economy that is starting to get more debt written into it. So that's actually, it's like kind of saying, on one hand, oh, we're going to do this, but you'll notice that they're not really doing anything they're saying, because there are loosening things going on in these environments around the world. So why is this important? Well, have a look at some of these names here. Of course, we've talked a lot about the UK. We've talked a lot about the Australian market where I am. Singapore market, also quite poorly priced up until recently. These are all the laggards. Also, China, we've spoken about many times. All of those are starting to improve. And in fact, if you look at the strength of some of the markets recently, we've got Colombia, Peru, Turkey, they're all actually starting to improve. And also we've got a lot of South American areas starting to get in there. Singapore in particular, very interesting market, along with China, as they're starting to come through over the last couple of weeks. So there's a lot of opportunity in this market right now, but there is also the idea that something is going on in terms of flow to the defensives. Again, here is an example. Utilities and treasuries usually correlate a little bit with each other. Now, if you've been following the treasury story this year, you would know that treasuries have been coming down. Now, they may have just found a base because, of course, we saw that weaker unemployment. We showed at the start of today's video that we might actually start to see unemployment continue to get weaker, so therefore that to actually start shooting up. Well, what's that going to do? It's going to bring up the number of, okay, maybe in the future we'll get some rate cuts due to that. Maybe we're going towards soft landing. Who knows what Jerome's really going to do? I tend to think he won't be able to do that many cuts, but at the same time, what we might see is still an improvement in treasuries because it's probably trading a little bit under where it should be. So treasuries are certainly completely disconnected with utilities, which is kind of unusual. And again, I think that shows you that the market is starting to turn a little bit defensive here. And usually this is the beginning. It takes a while. Remember, this isn't just like, oh yeah, we're defensive. I'm looking at utilities for at least 12 to 18 months here, seeing how they're performing. Are they starting to perform as one of the better sectors in the market? If you look through history, you'll find that when utilities start to do that, it's not usually just like, oh, it's the end of the market, but it is the beginning of something you really need to start looking at. Energy was another hot market recently that has dropped back down. It's actually something that we'll look at later on today's video, and it is starting to show some improvement, but it's back in with all the other sectors. So it's clear that utilities is absolutely smashing it right now. Couple of other things. Apple, of course, could this be the catalyst that gets this market going back on? Remember, the market's not moving on really good earnings necessarily. It's moving on good earnings, but it's also moving on buybacks. Now, this is pretty dodgy, in my opinion, to do these kind of $110 billion buybacks. I think it's absolutely ridiculous, but it's where we're at in the markets. And you've got to remember that when we get these huge reads like we just saw on Apple, this is actually the best gap up according to Optima since November 2022. Now, when we saw gaps like this, you'll notice that the general results, other than this one over here back in 2012, the general results have been relatively positive. Now, this is a chart that goes back a very, very long time, but the one over here in 2022 led into a very nice steep increase. $110 billion, it's nothing to sneeze at. Of course, it means that there are less positions in the markets and then there's less stock in the market and there'll be some kind of demand. The market loves a good buyback story, so that's why it ended up sticking its landing after the earnings call. When you look at these things, though, you can't really say you're very, happy about it. Realistically, did they mention AI a million times? Not really. They just said here, we continue to feel very bullish about our opportunity in generative AI. We are making significant investments and we're looking forward to sharing some very exciting news with our customers soon. We'll see how that plays out. But anyway, that's Apple for you. What about Wayne's data? Well, Wayne said here S&P 500 performance during the 4-quarter breakdown, in particular looking at, of course, the sell in May and run away and go away, didn't really play out as much as you might think. Now, of course, quarter one is incredible quarter in general. Quarter two, still a pretty good quarter. Quarter three gets more questionable. And of course, quarter four is where some sneakiness kind of comes in. But I think the thing is here that in general, if the price action is looking good, which we'll look at in the moment, if the positive gamma situation starts to improve, then there are still opportunities. Now, one of the things I mentioned to our Market Masters Club, if you ever want to join that, link in the description down below, as we saw the non-farm payrolls number come out, is I thought it might be pretty good for a couple of markets. In particular, maybe it's put a low in clean energy and solar. And of course, biotech has been struggling recently as well. But in particular, solar has been showing some signs of strength on the charts. Obviously, it's not too good initially for gold. Gold's doing that little bit of a pullback. But this is what we saw through the Friday session and through last week's session. We started to see a basing potentially here from the solar, from the clean energy, from the biotech. All of these industries that got absolutely smashed due to how high rates are. Have they turned it round? Let us know in the comments down below. I'm always interested to see your opinions. Let's jump on over now to who's winning in the market. Let's have a look at the S&P 500 together. And first up, I've got the advanced decline line on the weekly here. And what you'll notice, it just made a new high. So realistically, it doesn't look like the underlying market is that weak. With a chart like this, we've discussed this several times, we always expected to get a 20 weekly moving average. That is what we call mean reversion. Now, if the market had continued down in negative gamma and we'd flipped around that 4980 zone towards the downside, we would have created, in my opinion, a cascade effect that would have got us into, or waterfall effect that would have got us to around 47, 48. Is that out of the question now? You never say never, but you also cannot ignore that that is a big dirty wick showing signs of strength. And if we get follow through in the next week, there's no reason that this market won't want to go on to a new high. We've got advanced decline going up. We've obviously got strength in the underlying in terms of the markets. I just want to show you here on the daily, again, the advanced decline making new all highs here. We have a big rejection wick coming through last week that has now been snapped to the upside. So this is a very bearish looking candle, no follow through, which is obviously what we were looking for to get, any type of waterfalling action in this market. And then it just kept going up. And what we saw was a very interesting telling sign last week, which was, of course, that when we opened on non-farm, we had 50-70 completely stacked with puts. So there were puts everywhere and we just didn't go down. We actually just kept shooting up. So I think the options market is moving this quite a lot. We're above the ribbon of the 20 and the 50. Again, that's usually a positive sign for markets. When you get above these ribbons, you've got to pay attention to them. And there are some things looking good. On the negative end, what do you think the most negative thing is? Well, it's got to be that we're starting to get into that 61.8 to 75 fib retracement. So when you're considering, where some of the heavier trades are, there are some up here. But if we clear that, of course, this last bit's usually a formality in terms of how the markets look. All right, let's go over to the futures market action. What's changed? So we went from negative gamma to positive gamma. Now, everyone that's familiar with 2024 so far would know that positive gamma situation is quite strong for the markets. And effectively, we had here the put. I changed it to 50-50 because that's where it is now. It says NFP, but it doesn't mean that. We had that 50-70 on the put zone. You can see we've snapped that. We've gone to a new high. And it seems likely that at least we're going to 51.75, 5,200. So I think I could see, at least day traders trying to push the markets into this last kind of bastion for the bears. If the bears fail here, though, there's a good chance that the markets will just keep rallying to new highs. And obviously, we might have a bit of strength here in the middle of the year into, I would say probably some type of, other pullbacks that happen later on this year ahead of the elections. I don't expect this year to be just like all smooth sailing. As you can see, the 2012 or even 76, generally what happens, we get pullbacks around this period, then we get rallies, then we get weird pullbacks that actually come down to similar prices that we are right now. And then we usually go strong after the election, leading into usually a pretty good year in terms of years ending in 5, specifically 2025. So what is going on? Here are the options moving forward. You can see the positive gamma situation playing through. I've written in 50-50 and technically 50-30 as well for the Monday and Tuesday market action. But as we move through things like 51.25, which is pretty much where we are right now, if we hold above that price, it creates that positive gamma situation that will then push the market, you would think, into the 5,200 call res. Because you can see here that 5,200, 51.75 is a very well struck call zone. 51.50 being Tuesday. Again, we keep holding up. That'll create hedging, meaning to buy futures by the street, and they'll have to push it through. So the key will be to hold this price action, to hold it on the high end, and hopefully you have a strategy that maybe can see that in the charts. Now, what about CTAs? Well, they just made a new high, so they basically were purchasing the S&P 500 come Friday, and they were also purchasing the NASDAQ. So clearly the CTAs have made a bit of a turn to the upside. Now let's take a look at whether we could see the US dollar start to fall off. Now, I've got an update on the real charts in terms of live updates a little bit later, but it did fall below, and I think rallies now could be met by sell demand for the US dollar, and it could come back down. Now, if that's happening, it's probably also meaning yields are starting to turn to the downside, even if they're just temporary, and that could be good for treasuries as well. So TLT, something in focus this week. What's going on here in terms of the world? Well, as we said, there are other markets outside the US that are doing better. In particular, the one we focused on recently has been the HSI or the Hang Seng, and it's doing amazing. I mean, this thing has absolutely turned the bottom. It has many good reads on it that are showing signs of basically what we call the China put being put in the market. And although there are scary things with holding international markets sometimes, it's been pretty good, and of course, been following that story for a while. On the bear side, just remember that the worst case scenario during an election year, generally speaking, if you take out outliers, was around on average negative 9.93. It's still possible, but it becomes less likely when we see that VIX ROC and we see the advanced decline line increasing, because that actually just means that underneath something better is happening. Whether we agree with it or not, you have to put your opinions on the side, and you have to come from an abundance mindset in the markets. And there's a lot of fear, of course, and I can understand why, because we're in late cycle investing. It's very tough to invest in late cycle. But the pillars, the concepts we've been discussing, the things we do on the live show on Mondays, hopefully they come through and help people to gain some kind of alpha or edge in markets. Let's now discuss the idea of this week's earnings, because it's Palantir, which is everyone's retail favorite. And then, of course, we've got Disney as well, that's coming out before the open. I can't remember if they always do before the open, but I feel like that's a little strange in itself. Then there's a lot of other stocks that are coming through. As always, we've got some of the big ones here in terms of what is the expected move. PLTR, be careful. LC, Lucid, be careful. Negative, positive 18.5% from Lucid according to options, and 15% from PLTR. DDOG as well, 12% moves. These are huge. Even Shop's got a 12% move on it. There's nothing more wild than when you go to earnings season and you see not only the mag stocks moving huge, 10% each way, but then you've got these smaller big tech stocks, they're moving upwards of 20% each way. I mean, it's just a wild time we live in the markets. I don't remember so many huge moves, so many billions of dollars shifting everywhere at any other point like this, other than in, of course, an epic meltdown crash. Now let's go over here to the VIX. So the VIX broke under 15. That's a fairly big deal. It doesn't mean it can't get back. Of course, this did happen during August where we dropped below and then we ended up getting a secondary kind of spike, but it did spike above 20, then it's dropped. The rate of change obviously has also gone from 40 down to negative 20, and this tends to be a relatively bullish sign for the market. You might say, well, it's low, so I'm going to buy the VIX. It's not quite how the VIX works, but the volatility has dropped out. When we look at our bonds market as well, our bonds options discussion that we've talked about, that spiked up, giving us a bit of a sign that something was not so good, and then it's come right back down. So again, there are not enough signs to say, oh, yeah, everything's terrifying in the markets right now. Same thing with high yield junk bonds. They gapped up because of the yields. They held their gap up higher. That's, of course, a little bit stronger in markets. When we look at the US 2-year, you'll notice it came down. Now, it hit this very important level and actually bounced off it. So interesting to see whether it's able to get underneath that low of last week, 4.72 on the 2-year. But you'll notice that went down. And then we also saw, of course, treasuries start to stabilize up 1%. So when you look at treasuries, it actually has started to turn to the upside, and it's doing so at a very nice golden pocket fib pullback of the overall move. So could I see some funds getting back into treasuries around here? It's possible. Again, you want yields to go down. I don't think it's going to be like a stellar, absolute epic trade, but I've spoken about it before that I think signs point towards treasuries maybe finding some lows around here from a technical perspective. Let's now move over to the S&P 500. As you can see clearly on the charts, there's been some central bank kind of lackluster support recently, but that spiked straight up as soon as we saw any signs of weakness in the markets. We got a little bit of liquidity put back into the markets. Dow Jones Transportation Average ended up improving. Home builders is holding steady. Again, signs of the market usually being relatively strong. You want to look at your financials as well. How are they doing? Well, financials haven't exactly, dropped off a cliff. You want to look at your regional financials as well, just to make sure that they're not dropping off a cliff. Well, the chart isn't. So, again, the evidence is stating that things are kind of, whatever reason, solid at this point. Copper is improving. Now, if copper's improving, you could say, well, that's inflation, and it is, but it's also underlying government expenditure. I mean, basically what this is it's world governments building weird infrastructure. Infrastructure is going on everywhere. If you go to your biggest city around, America or Europe or Australia or whatever, I bet you see a bunch of cranes everywhere floating around, building a bunch of junk that no one really wants to live in, but it's being built. And it's not going into what we need as people. It's going into building some apartments because we're told we need the apartments. We need them, guys. So infrastructure and government expenditure is still out of control. And at the same time, that is usually long tail. So that's why it's leading through into this point. So we watch those leads and we always check them out. What about the US dollar? Well, the US dollar dropped off and it fell. Now, it hasn't gone to my level on the blows here around 104. So I think that the dollar might strengthen into weaken. Now, could it strengthen up to this level? Ooh, it's a pretty good zone. I'd say most traded level, 105.70, golden pocket. A lot of things that you might like about being a bear on the dollar at this point. It will be interesting to watch this on this week. I think currencies are back in focus. In particular, be careful of the US dollar yen because of the intervention, and obviously the US dollar will be interesting as well. When we move over to gold spot, it becomes a little bit more murky. So, I'm a big gold bull. Of course, I think gold's going to 3,000 an ounce. I've called that for a very long time now. And this is nothing new to most people that have been watching. Do I think gold can still let go down a little bit though? It's possible, and I think this is still a thing. So it's holding its little bull zone, but if it gives this up and it hasn't been able to close a proper day underneath it, then we're probably going to 21.72. Do I like that zone as a gold bull? I think it's pretty good. I think it's pretty strong, and I wouldn't mind it to do that because you can notice here that this weekly 20 moving average has been a 1 and a 2. So generally the third time, it's the 1, 2, 3. It's not too bad. What about gold junior miners? Not doing very well in comparison. Now, there's a couple of reasons for this. I think that I actually looked at, I don't have the stat for you, but basically gold coins, so I think they're called gold eagles or something like that in America, they're actually down. So retail traders aren't actually buying them. Now in China, everyone's buying, you can look this up, golden beads or beans, golden beans. So people are buying golden beans, but at the same time, central banks are making up the huge purchases of gold. That's actually who's been accelerating. I've shown that chart quite a few times. Gold juniors really behind the times, and that's because central banks aren't actually buying gold, like as in like buying for production. They're buying just because they want to hoard it. So this is because we're in a CW, and you guys know what that means. But VanEck gold miner ETF still very low. Now the juniors are very low. Juniors are horrendous. So I think as other people start to join in on that crowd, you wouldn't be surprised at all to see maybe them starting to come through. A dangerous trade and a dangerous investment indeed if you don't know what you're doing, because of course they can get crushed at the same time. XLE, you'll notice here that energy stocks are back down to around the levels where you'd like to start seeing some strength. There is not enough strength here, I don't feel. But if you believe in inflation or stagflation, this will be an interesting zone for you. And of course, we're looking at how oil ends up trading through this point. So if we bring up oil, let's do that now. We had a feeling that oil would go to exactly where it is. Well done, guys. I'm giving you a clap because this is pretty damn good. Now, has it gone in there the way that you'd want? Look at that weekly. Oh, it's brutal. It's a massive, big red horror show, and it closed right into our zone. Now, that makes it a little tough because, of course, I don't like buying into a closed level unless I'm just scaling into a position. It's a very dangerous point. So we're looking for market structure around here. I don't mind looking for a little bit of structure. Structure traders, unite, I guess, around this area. And what we're looking for is buyers to show some commitment. Do I like this zone? I mentioned it's a great bull zone, so we'll see whether it can hold. We're looking at the moment to see some strength come back into the market. We haven't. And this just shows you again, one of the things I think we've been really good at navigating is we don't care about the narrative and the storylines. Instead, we follow the price action. If you follow the storylines on oil throughout the last 6 months, you would have lost so much. It would have been horrendous. But if you've been following the price action, you would know that it's been front running the storylines a lot of the time. And that's because AIs and other things have information that we just do not have behind closed doors, and they tend to push it before things happen. Let's move over to Tesla. Tesla still looking quite strong. I wouldn't be surprised at all if it's done the turn in terms of sentiment. A lot of people disagree with me on this. I would say that that Elon probably did his best ever kind of earnings call, and he's convinced the market of a lot of things. I also think that AI discussion will move from chatbots and these types of things that we're at right now into what about humanoids? Do I think they're ready? No way. Do I think they're going to come through over the next coming years and be useful and everyone will like them? No. But the thing is, the markets, they love this type of thing. They love Ford. So, where are the levels? Where are the interesting zones? We've got the most traded zone and we've got the 162. So you might disagree with me and say, look, the humanoid robots are amazing. They are, but I still think they're longer than people think away. 5 to 7, 10 years maybe. It's a while. We'll see who's going to be proven right on that one. But I do think the sentiment has shifted on Tesla, and that's brought the retail traders back in. And now people are going to use it as an AI company. So that gives the valuation back up. They'll stop focusing on the cars and they'll start focusing on the AI storylines. You watch them go. What about Apple? Well, the 110 billion buyback is utterly ridiculous, but it did end up sticking the landing. So that kind of shows you that pullback's probably going to be met by bull demand on this. That's the way the market tends to like it. So that'll be interesting one to watch. We saw AMD possibly bottom off last week, one that we've been discussing, coming out with actually an island reversal low, splitting the 61.8 fib, obviously looking improvement, something I've discussed a few times. SMCI, another retail favorite. As we said, we believed over here in February that we would get a pullback in time or a pullback completely in price. And of course, we've seen a lot of time burning. So that's multiple months of burning in probably arguably a pretty good stock. Maybe this is where we expected the bulls to kind of hold. They're holding for now. We'll see whether they can get through. Best stock in the world at the moment, NVIDIA. Most traded zone, still trading around that area. No breakout, but certainly at the res. Then we've got utilities. Look at the utilities go. So it's hit the resistance that we see, but still I think the trend is pretty good on that chart. HSI, which is of course the Chinese chart, breaking out 18.5, looking towards 20,000 in terms of technicals on this one. We've been following this for a long time. We started really going hard on it in Feb in terms of discussion point. It just shows you, again, you can look at different markets. There are abundance out there. There's lots of opportunities, guys. Don't go just, oh, I have to be in this, or FOMO. You just lose. FOMO is bad. Like, one thing I learned back in the early 2000 and probably 10s, I think probably about 2011 and stuff, is I used to, like anyone, you used to chase things like a little bit. Like, I'd already gotten past that a bit because I got burnt in the GFC from chasing things. But at the same time, what you'll notice is that you end up realizing that there might have been a trade last week that was amazing, but there's also a trade this week that's amazing. And there's another one the next 2 weeks, another one. You've got to remember that joining in on a trend halfway through, where's your stop loss? What's your risk management? What's your Sharpe ratio? All these things become a huge issue. And if you don't know what Sharpe ratio is, you need to look that up. Now let's move over to the US market in terms of strength or weakness from the NASDAQ and the US 2K. You'll notice here that the NASDAQ has improved, making a new higher high, obviously getting into some tough zones here. If we go and put a fixed range on this area and zone, you'll notice that we're getting into that kind of resi area. Again, I think the S&P 500 is going to be key here. So you're really going to need to see the S&P 500, what's going on with those options. Do we push that positive gamma situation up, which seems to be the more likely scenario at this point? It has changed trend towards the uptrend on most of the time frames in terms of the small ones at this point. US 2K, now this one also has changed to the upside as well. It did end up closing at around that 50 daily moving average and also a little bit of res. So you could call out a little bit of resistance. You'd also notice that I think this is a correlation line, yeah. But if we look at the way that it's come off a pretty good zone. It's shown a wick there. It's closed relatively well. I think pullbacks are going to be met by bull demand at this stage. So again, the Russell 2K, holding a very nice level. And as we mentioned over the last couple of weeks, that 1950 zone was very strong buying by someone. We saw that in price action a few times. Let's now move over to the crypto market. So we'll look at Bitcoin. Now, this was very sneaky Bitcoin, very sneaky. So my initial thought process was we'd get under 60 and we'd flash crash to 52. Now that became the normal and everyone saw it and everyone was talking about it on X. And then we did some deeper diving. I posted this over on X. I also brought it to a video while we were still sitting at 57. And I kind of said, well, wait a second, 57 is better than I thought. So 57 had the 20 weekly moving average, which we know is respected. Mean reversion is respected in many markets, including this one. We also had some VWAPs. We also had a fib. And then, of course, we got a double wick rejection off that period. Now, where are we right now? Well, we've grown through the first resistance. So therefore, we go to the second one. We always knew this was the second one. And we are absolutely where the bears, if they are even going to press it, they have to press it pretty much right in here. If we break through this zone, pullbacks to be met by bull demand, I would think, and Bitcoin is certainly improving. And already it looks like it's possibly putting its low. And I think the storyline in crypto world is, or anything really, is that if you expect, let's say, between 15% and 30% in a bull market towards the downside, which is what I usually expect, here's 30, here's 15, here's 23 or something. So in all, if you're a scaler or something like that, it did come down pretty well. Maybe it's still not over. We'll see how this is, but this weekly close would be very strong. Obviously, you cannot look at a big wick like that in a negative way. Generally, it shows you someone was willing to buy, and it would have crushed a lot of people around here. So we'll have to find out how Bitcoin ends up trading. Bitcoin, Ethereum, interesting trades. You can see here Ethereum, lots of wicks off the low, again looking pretty strong if it holds the weekly above the close. As always, guys, we're looking at news ahead, so let's quickly zoom in here and have a look. We've got the Bank of Japan with a bit of a holiday. Then we get the RBA coming out, which is for Australia. Then we get a bunch of European holidays. And as you'll notice here, we have a pretty weak news week. You wouldn't really say it's like insane. What I would be looking forward to in terms of where are we really going to see some big questions being answered, it's going to be Wednesday, the 15th of May, at 8:30 a.m. on New York time, which is the core CPI result. That's going to be the more interesting kind of thing. If you want to find out more about what we do, then of course subscribe, smash that like icon or the like button, and of course smash the bell as well. We're coming live to you on Monday for the Open, so definitely join us. And if you want to find out more about our courses and some of the other things we do as well, and better understand why these markets all move together, then why not check out some of our courses down below. Thanks so much for watching, guys. You have a great weekend.